What is Forex? The basics. Basically, the Forex market is where banks, businesses, governments, investors and traders come to exchange and speculate on currencies. The Forex market is also referred to as the FX market, currency market, foreign exchange currency market or foreign currency market, and it is the largest and most liquid market in the world with an average daily turnover of $3.98 trillion. It should be noted that there is no central marketplace for the Forex market. Trading is instead said to be conducted over the counter. It's not like stocks where there is a central marketplace with all orders processed like the New York Stock Exchange. Forex is a product quoted by all the major banks, and not all banks will have the exact same price. Now, the broker platforms take all thesis feeds from the different banks and the quotes we see from our broker are an approximate average of them. It's the broker who is effectively transacting the trade and taking the other side of it to make the market. A brief history of the Forex market. Okay, I admit, this part is going to be a little bit boring, but it's important to have some basic background knowledge of the history of the Forex market so that you know a little bit about why it exists and how it got here. So here's the history of the Forex market in a nutshell. In 1876, something called the gold exchange standard was implemented. Basically it said that all paper currency had to be backed by solid gold. The idea here was to stabilize world currencies by pegging them to the price of gold. It was a good idea in theory. The gold standard was dropped around the beginning of World War II as major European countries did not have enough gold to support all the currency they were printing to pay for large military projects. Although the gold standard was ultimately dropped, the precious metal never lost its spot as the ultimate form of monetary value. The world then decided to have fixed exchange rates that resulted in the US dollar being the primary reserve currency and that it would be the only currency backed by gold. This is known as the Bretton Woods system and it happened in 1944. I know you're super excited to know that. In 1971 the US declared that it would no longer exchange gold for US dollars that were held in foreign reserves. This marked the end of the Bretton Woods system. It was this breakdown of the Bretton Woods system that ultimately led to the mostly global acceptance of floating foreign exchange rates in 1976. This was effectively the birth of the current foreign currency exchange market, although it did not become widely electronically traded until about the mid-1990s. What is Forex trading? Forex trading as it relates to retail traders like you and I is the speculation on the price of one currency against another. For example, if you think the euro is going to rise against the US dollar, you can buy the erst currency pair low and then hopefully sell it at a higher price to make a profit. Of course, if you buy the euro against the dollar erst and the US dollar strengthens, you will then be in a losing position. So, it's important to be aware of the risk involved in trading Forex, and not only the reward. Why is the Forex market so popular? Being a Forex trader offers the most amazing potential lifestyle of any profession in the world. It's not easy to get there, but if you are determined and disciplined, you can make it happen. Here's a quick list of skills you will need to reach your goals in the Forex market. Ability to take a loss without becoming emotional. Confidence to believe in yourself and your trading strategy, and to have no fear. Dedication to becoming the best Forex trader you can be. Discipline to remain calm and unemotional in a realm of constant temptation. And market flexibility to trade changing market conditions successfully. Focus to stay concentrated on your trading plan and to not stray off course. Logic to look at the market from an objective and straightforward perspective. Organization to forge and reinforce positive trading habits. Patience, to wait for only the highest probability trading strategies according to your plan. Realism, to not think you are going to get rich quick and understand the reality of the market. And trading savvy, to take advantage of your trading edge when it arises and be aware of what is happening in the market at all times. Self-control, to not overtrade and over-leverage your trading account. As traders, we can take advantage of the high leverage and volatility of the Forex market by learning and mastering an effective Forex trading strategy, building an effective trading plan on the strategy, and following it with ice-cold discipline. Money management is key here. Leverage is a double-edged sword and can make you a lot of money fast or lose you a lot of money fast. The key to money management in Forex trading is to always know the exact dollar amount you have at risk before entering a trade and be totally okay with losing that amount of money. Who trades Forex and why? Banks. The interbank market allows for both the majority of commercial Forex transactions and large amounts of speculative trading each day. Some large banks will trade billions of dollars daily. Sometimes this trading is done on behalf of customers, however much is done by proprietary traders who are trading for the bank's own account. Companies need to use the foreign exchange market to pay for goods and services from foreign countries and also to sell goods or services in foreign countries. An important part of the daily Forex market activity comes from companies looking to exchange currency in order to transact in other countries. Government central banks, a country's central bank, can play an important role in the foreign exchange markets. They can cause an increase or decrease in the value of their nation's currency by trying to control money supply, inflation, and/or interest rates. Hedge funds, somewhere around 70 to 90% of all foreign exchange transactions, are speculative in nature. This means, the person or institutions that bought or sold the currency has no plan of actually taking delivery of the currency. Instead, the transaction was executed with sole intention of speculating on the price movement of that particular currency. Retail speculators, you and I, are small cheese compared to the big hedge funds that control and speculate with billions of dollars of equity each day in the currency markets. Individuals, if you have ever traveled to a different country and exchanged your money into a different currency at the airport or bank, you have already participated in the foreign currency exchange market. Investors, investment firms who manage large portfolios for their clients use the FX market to facilitate transactions in foreign securities. For example, an investment manager controlling an international equity portfolio needs to use the Forex market to purchase and sell several currency pairs in order to pay for foreign securities they want to purchase. Advantages of trading the Forex market. Forex is the largest market in the world, with daily volumes exceeding $3 trillion per day. This means immense liquidity, which makes it easy to get in and out of positions. Trade whenever you want. There is no opening bell in the Forex market. You can enter or exit a trade whenever you want from Sunday around 5 p.m. estate to Friday around 4 p.m. estate. Ease of access. You can fund your trading account with as little as $250 at many retail brokers and begin trading the same day in some cases. Straight-through order execution allows you to trade at the click of a mouse. Fewer currency pairs to focus on, instead of getting lost trying to analyze thousands of stocks. Freedom to trade anywhere in the world, with the only requirements being a laptop and internet connection. Commission-free trading with many retail market makers and overall lower transaction costs than stocks and commodities. Volatility allows traders to profit in any market condition and provides for high-probability weekly trading opportunities. Also, there is no structural market bias like the long bias of the stock market, so traders have equal opportunity to profit in rising or falling markets. While the Forex market is clearly a great market to trade, I would note to all beginners that trading carries both the potential for reward and risk. Many people come into the markets thinking only about the reward and ignoring the risks involved. This is the fastest way to lose all of your trading account money. If you want to get started trading the FX market on the right track, it's critical that you are aware of and accept the fact that you could lose on any given trade you take. Thanks for watching. Don't use Forex. That's a wrong idea. You can get down at 1 second. Give up Forex.